Now, one of the things to keep in mind is gold is behaving exactly like it did in the mid 70s, right? So you have the big move up starting in 2018 and ending in 2020, right? So it was about a 2-year move up.
Okay, now let's move over to gold and talk about how gold has reacted to this week's news. We've seen a decline right now. We're talking on Friday. It's under 1800 the last time I checked, although gold had been rising throughout January. So I
Mhm.
wonder if you can review gold's recent price action and how we may see it perform as we head toward, the next Fed meeting when we'll get some more news on what they plan.
Yeah. So looking at the chart, it's amazing because the chart is so accurate in calling these levels, right? So what's amazing to me about the gold chart is that if you connect all the recent highs, including the one from just literally a few days ago, look at how it was right into that trend line. And then we've pulled back here. And what you can do is you can also connect all the same low levels. So what this tells us is gold is still trading in a range, right? It's what we call a wedge pattern. I'm still in the camp that we do see a breakout of the wedge pattern to the upside. And once we break out over this top down sloping trend line, you should very quickly kind of go to the former all-time high of from 2020, which was around 2075 per ounce on gold. Now, one of the things to keep in mind is gold is behaving exactly like it did in the mid 70s, right? So you have the big move up starting in 2018 and ending in 2020, right? So it was about a 2-year move up. And now we've been consolidating for getting close to a year and a half to 2 years. And I'd love to show this chart. If I go to my monthly chart and we go back to the 1970s, and bear with me as I kind of get the chart set up for us, you can see that same sort of price action. So in the early 70s, when there wasn't a ton of inflation yet, you had a big move up. I look at this as what happened between 2018 and 2020. Then, when inflation started to bubble up in 75, 76, gold actually went down and consolidated here for about 2 years. It wasn't until kind of 77, 78 where gold had this epic move to the upside where it went from $100 to about $800 to $900 an ounce. So what I'm thinking is that in the scheme of replication, right? And if you look at the inflation data, it's very consistent with what we saw in the mid 70s to 80s. And if this move is replicating, we're probably right around here in this range here on this move in gold currently. And I do expect a big move to the upside. Now, again, from $100 to 800 or 900, I don't think percentage wise we're going to do that with gold. Maybe we do, but I would highly doubt that much. But do I think we can go to $3,000 to $5,000 an ounce in the next 5 years? Yeah, I do. I actually do think that is a possibility because, again, I'm so doubtful that the Fed can ever really, fully tighten and remove all monetary policy. So essentially, you have so much U.S. debt, you have the Fed in a predicament with recessions and having to just print more money that inevitably they're going to have to go back to that game plan, increasing the dollars out there and then ultimately driving up gold.
Right. And I think this is quite informative because as we've been seeing inflation over the last year or so, I know there's been a lot of people saying, well, isn't gold a hedge against inflation? Why is it simply, kind of going along as it was instead of increasing? But if we look back, as you're saying, we can kind of understand how that pattern plays out.
Yes, that's exactly right. And I think it makes sense from a psychological aspect too, because, you had the big run from 2018 to 2020. I think honestly, that was the gold market anticipating a rise in inflation, right? So, they saw what the Fed was doing. They saw the amount of printing going on and they said, okay, we got to readjust gold's price. And now you've kind of gotten this period where investors are saying, okay, well, we see the inflation that gold was predicting by that bigger move, but is it going to last? And as soon as you see signs that it's going to last longer, the gold market will very quickly kind of react to that and start its upward move, in my opinion.
Yeah, that's exactly what I was hoping we could talk about. We have all these things in play now. We have the tapering that's supposed to wrap up. We have rate hikes that are then supposed to start. And now we also have the balance sheet kind of discussion starting to begin. So, can you help us unravel those three things? And what do you think is the most important here for investors to pay attention to?
So I think the market was anticipating the tapering because the tapering was something that was the QE essentially was something that was put into place at the beginning of COVID in March of 2020, and it was meant as kind of emergency measure. So we always knew that that was going to come off the table. With a stronger economy, you figured, okay, some rate hikes in the mix there if we're really strong. I think what shocked the market, and you saw this, right? We knew that they were going to do those first two measures mid last year, right? We knew that was going to come. But what we didn't know was the reduction in balance sheet, which is 9 trillion or more dollars at this point. Now, how much they reduce it by, we don't know. But again, I think that was kind of the straw that broke the camel's back for the equity markets, where we started to then see these big moves to the downside, 2%, 3% drops in the US markets.
Yeah, and this is quite interesting. I think we've talked about this together before about how Powell has been pretty clear about what's going to happen. There are not really a lot of surprises when we get to these meetings, but this does seem to have been a little bit surprising for people. So maybe, how does that all fit in?
Yeah, so it definitely was a surprise, which the markets do not like, right? Markets do not like what they don't see choreographed, miles ahead of time, essentially. So I think for the markets, they're saying to themselves, okay, well, the Fed was off on the inflation being transitory. Now they're showing us this kind of panicked, we got to do all this at once type thing. And that's the real risk, because if you look at since, you could argue at least from 2009, the markets have been grinding higher with a few blips, but for the most part, it's because the Fed has always been there and the markets have trusted that the Fed will always be there. And now with inflation spiking, the question is, number one, did the Fed, miss the ball here and not start tightening a year ago, for instance? And then number two is, can they even get inflation back under wraps? And, I'm very skeptical. I think, 8-7% inflation where we are right now, I certainly don't think we're going to stay there. I think you will see, as supply chain kind of is dealt with, we'll get inflation down. But the concern here is, does it get below 5% or 4%? I don't think it goes back to 2%, considering the wage hikes that have occurred that will be passed along in the consumer products over the next multiple years. So my forecasts are showing 4 to 5% inflation over the next 3 years, 4 years. And I think that's going to put a very tight situation for the Federal Reserve, where what happens when we do enter a recession, when unemployment goes up? How does the Fed react with an inflation number that's staying sticky around 4 or 5%?
Right. And let's talk a little bit more about what's going on in the overall market. So they were not happy with this news from the Fed, although really we've been seeing declines since the start of the new year. So probably I think what people are wondering is this going to continue? That's pretty tough to answer, but what are your thoughts there?
So I have a really interesting chart here I'd like to show. It's the S&P, or the Spiders ETF. And what you can see here is that you had a definitive kind of move up when the extraordinary measures were introduced for COVID. So here was your COVID dip, right? There was your COVID panic. And then from that, you got this incredible kind of stimulus that the Fed and the US government put into play. And you could see the vertical nature of the markets and how it stayed in this kind of channel, right? We have this lower channel line, you had this upper channel line, and it was just a constant grind higher until recently. And this to me stands out as a breakdown of trend. And I think what's important also is to recognize that if you zoom out on this chart and you go back to 2013, 14, 15, the long-term trend for the markets was here. And it only makes sense to me that if you're really getting rid of these extraordinary measures that the Fed put into place, that you should see more downside into this area here, right? So you probably come back in this range at some point, which brings us back to that kind of fair value that the markets were in. Now, if we start to slip into a recession, do we go below that? Maybe. But at this point, in the very least, you can see how the market ripped higher on that kind of steroidal push by so much stimulus. And now, again, being taken away, it only makes sense that we come back in that kind of longer term trend on the market. So that's kind of where I'm at right now, where I still think there's more downside. You're going to get great bounces along the way. We're seeing a decent bounce today in the equity markets after some economic data came in a little bit better that the market wanted to see. But I certainly think there's more downside.
Right. And, the market reaction, I think, kind of reflects confidence that the Fed is going to be able to do what it says it will do and follow these plans it's laid out. I know that you don't necessarily believe that that's true. So what are you thinking as we move forward into 2022 from the Fed in terms of what it can actually accomplish?
Yeah, I mean, the track record of the Fed since 1977, when they received the dual mandate, which included unemployment at that point, has been one where, we have a recession, they lower interest rates a lot. And then when we come out of that recession, they only raise interest rates a little bit before the next recession. And so it's kind of been a stair step where you come down, a little bit of a bounce, come down. And that's how interest rates have gone. So I'm very skeptical that they can get us back to anything resembling even the new normal on interest rates, the balance sheet getting down reasonably to maybe 3 trillion or even 4 trillion without them causing another recession. And then the question is, well, if they do cause another recession, what measures can they employ? I mean, do they just go back to printing money nonstop to stimulate again? Then what happens to inflation? What if inflation's at 4% instead of 2% at that point? Do we see a 12% handle on inflation? So the Fed is really in a tight box here. I'm hopeful that there's something that they can maneuver to kind of get us out without causing massive inflation, but it's certainly something where I don't think they're going to be able to raise more than two times in 2022.